Hello, and welcome to the latest edition of the Quarterly View from Glassy Mountain Advisors. I'm Jordan Smythe, the founder of Glassy Mountain Advisors, and I appreciate your joining us now for this presentation. I'm going to begin by providing an overview of the stock market's performance so far in 2022, and then I'll provide our outlook and some investment implications. To summarize our views, we are not surprised by the market's recent decline, particularly after an extraordinarily strong run for stocks since the onset of the COVID-19 pandemic in early 2020. We do realize, though, that even though such pullbacks are inevitable, they are never enjoyable. We expect more volatility in the near term and are looking for opportunities to purchase shares that are trading at significant discounts and offer the potential for healthy long-term returns. After a tremendous gain of nearly 29% in 2021, stocks started to drop in January and hit a bottom by mid-March. The S&P 500 index experienced an official correction, or a decline of more than 10%. Stocks then recovered sharply through the end of the quarter before slipping again in April back into correction territory, and the S&P 500 index is now down about 12% so far this year, including dividends. Meanwhile, bond prices dropped as interest rates rose, as you can see on this chart of the 10-year Treasury yield. The Bloomberg Barclays U.S. Aggregate Bond Index lost 5.9% during the first 3 months of the year, the worst quarterly performance in over 40 years, and is now off about 9% for the year to date. Rising inflation and the U.S. Federal Reserve's plans to increase interest rates and shed assets were already weighing on investors as the year began. And during the first quarter, supply chain issues and strong demand from consumers emerging from pandemic lockdowns drove up prices for many goods. Core inflation rose to levels not seen since the early 1980s, including a 6.5% annual increase in March. Employers continued to struggle to fill open jobs due to the tight labor market, and employment returned to close to pre-pandemic levels. Wages rose as a result, adding to inflationary pressures. The Fed ended its bond purchases in March and increased the federal funds rate by 0.25% as planned. As concerns about inflation mounted, the Fed also stepped up its plans to increase interest rates further, raising concerns that these efforts could tilt the economy into a recession. As if the potentially overheating economy and ongoing supply chain issues weren't challenging enough, Russia's invasion of Ukraine on February 24th gave investors another reason for concern. The war exacerbated supply chain problems and caused oil prices to spike to over $120 a barrel, both of which added to inflationary pressures. The United States and its allies have responded to the invasion with sanctions on Russia, but have also been wary of measures that would potentially harm their own economies. President Biden also tapped into U.S. oil reserves to try to tame gasoline prices. Finally, COVID-19 continued to have a negative impact on the global economy. A surge in cases from the Omicron variant at the end of 2021 caused consumers to curtail some activities and spending. New cases have since waned in the United States and in other areas of the world, but the Chinese government's strict lockdowns that are intended to prevent COVID-19 spread have slowed economic growth locally and caused more supply chain issues. These challenges remain critical factors as we start the second quarter and look further ahead, and we expect the recent volatility in markets to continue. We'll be watching closely to see whether the Fed is effectively able to tame inflation without sending the U.S. economy into recession. Inflation remains high, even though oil prices have fallen back to around $100 a barrel now. The Fed will likely increase rates by 0.5% in May, which will be the first 0.5% rate hike since 2000. There's even talk recently of one or more 0.75% rate increases. The employment situation has improved dramatically since the onset of the pandemic. As already noted, wages have climbed after many years of slow growth. However, wages adjusted for inflation, or real wages, have actually declined, and demand for workers appears to be cooling. It's critical that inflation rates come down so that workers can maintain their spending to support economic growth. Consumer spending growth slowed in February, and the University of Michigan Index of Consumer Expectations hit a 10-year low in March before rebounding in April. The housing market may provide some clues as we watch for signs of any further decline in spending. Tight housing inventories and rising construction costs have combined with strong demand, particularly from first-time home buyers, to boost home prices, which rose 20% in February compared to a year prior. However, mortgage rates surged from 3.2% at the beginning of the year to over 5% recently, the highest level since 2010, and that increase in rates may crimp future demand. Sales of new homes, in fact, declined over 12% in March, an early sign of the impact of higher rates. Rising costs of energy due to the Russian invasion of Ukraine and of other goods and services may lead potential buyers to delay home purchases and other spending. We'll be watching these trends closely. Another potential warning comes from the difference between short-term and long-term interest rates, or the yield curve. Short-term rates ticked above long-term rates briefly earlier in April, a condition known as a yield curve inversion, which can be a harbinger of a recession. The situation in Ukraine will continue to impact the global economy and consumer sentiment, particularly in Europe, where economic growth is slowing due partly to the surge in energy prices resulting from the invasion. Inflation in Europe has quickly risen to multi-decade highs, and governments there are shifting investments to defense spending. COVID-19's ongoing effects will remain another critical factor. New cases are down significantly from the highs in January, but they are ticking back up in some places as the latest variant spreads. Aggressive efforts by the Chinese government to halt the spread of COVID-19, including severe lockdowns in Shanghai and elsewhere, are causing more problems with the global supply chain. Notwithstanding the threat of a resurgence of COVID-19 cases, the U.S. economy will likely continue to expand, and corporate earnings should rise, but increases in both will likely moderate relative to last year given current conditions. We think the market may be stuck for a bit in its recent range with ongoing volatility. As for our portfolios, we believe there should be good opportunities for long-term capital appreciation both in the United States and abroad. The S&P 500 index currently trades at 19 times expected earnings for the next year, in line with its 5-year average, and we see potential for future gains from here. We favor shares of companies that have strong competitive positions and the ability to increase prices if necessary to maintain profit margins. And for income investments, we prefer high-yielding stocks of companies with the potential to increase dividends, and also favor short-term to intermediate-term bonds over longer-term bonds. Thank you for taking the time to join us. We hope you enjoyed this presentation. We welcome your questions, comments, or suggestions as always, and we hope you stay safe and healthy as we move towards summer. Take care.